Hi folks, this is Sean Hyman from Chart of the Day, and I want to talk to you about a common fallacy that I see people do. A lot of times people will say, they think if they've got more indicators on a chart that they get more confirmation, but really what that does is gives you what I call analysis paralysis. And for starters, there are certain indicators that really do the same job. For instance, the slow stochastics and the RSI do the exact same job. So if you'll take one of those off your chart, it'll widen out your price action. You'll be able to see more things happening in the trend. Trends will become more obvious the wider this price action is allowed to be. The more you squish it down, the less noticeable trends are and the less noticeable candle patterns are. But I just wanted to go back to my argument here about the slow stochastics and RSI. I've put a slow stochastics 1433 setting on here and the traditional 14 period RSI. So they're both judging overbought and oversold levels, and they're looking back 14 candles to see whether the present candle is overbought or oversold. In other words, where it is right now, whether it's overbought or oversold. And the reason why I like slow stochastics better than RSI, which RSI is on the bottom, here's slow stochastics here, is because the slow stochastics will give more signals in analyzing and doing the same job than RSI will. For instance, when we first look at a chart, we should not draw our eyes first to down here. First, we should always force and train our eyes to look up here. What is the trend doing? What's the price action doing? Which direction is this going? Well, it's coming from the upper left to the lower right, so that's one way we can say it's a downtrend. We can say the highs are overall lower and the lows are overall lower, so we can say that's a downtrend. We can put a 200 period simple moving average on the chart, and I call that trend lines on training wheels, because when you tell your chart to put on a 200 period SMA, each charting package will have their own list of indicators that you can use. And you put in 200 when you choose the periods for the simple moving average, and it automatically plots this on. There's no way you can mess it up. And that's what I like, because a lot of people when they're new to markets, that we need something at first that we can't mess up. I could draw a trend line and maybe I drew it right, maybe I didn't, but if I use a moving average, well, it's automatically calculated on it correctly, so there's no way I can miss, no human error involved there. And so this is sloping downward, so it tells me that the price is in a downtrend by several different metrics that we just discussed. Therefore, I should only look for entries which are short, in other words, sell signals in these indicators below the chart. That gives me a higher probability trade, because remember, you first always want to trade with the trend, so you want to define the trend first and then look for entry signals in that trend. And the reason why a lot of people will say, well, I tried indicators and they don't work, is because they'll take any buy or sell signal that comes along. Well, how many of you know if I took this buy signal here, 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 any of these, it would not have worked well. It would have continued to go down. Why? Because we were in a downtrend. But had I chosen this sell signal, 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 I would have come out a lot better as well. So it doesn't mean even that every sell signal in a downtrend is going to be right, or every buy signal in an uptrend is going to be right, but what it does is it stacks the probabilities on your side to where maybe 7 out of 10, 8 out of 10, 9 out of 10, what have you, will be correct. Now with that said, going back to our stochastic versus RSI here, here we get a stochastic sell signal, but we don't get one here on RSI. Here we get a stochastic sell signal that comes up and it hits the 80 and crosses over, but we don't get one on the RSI. Here we get another one on the stochastics, we don't get it on RSI. Finally, we get two in common here with RSI and stochastic. And again, we get one in common here with RSI here, and then this one barely pulls off a signal, where this one clearly gives a signal. So, we got probably twice the signals out of slow stochastics with the same 14 period setting as the RSI on 14 period setting, so that we're apples to apples on its analysis. And they're both judging overbought, oversold, but the stochastic did a whole lot better job at it. Also, it's very clear when lines come up, cross, and turn downward. It's easier on the eyes than what we see here with the RSI as well. So it's another reason why I like it better, but mainly because it gives more signals and more accurate signals than if I just use RSI. If I just used RSI, I would have had, if you start at the far left of the chart, 1, 2, 3, 4, 5 signals with RSI. Stochastics I'd had 1, 2, 3, 4, 5. So I've already had as many as RSI's had, even halfway on the chart. 6, 7, 8. So I got several more signals out of the same chart, judging overbought, oversold, using slow stochastics as opposed to RSI. And I was on the same 4-hour, 40-day chart. So over the 40-day period, I got 3 more bona fide signals with slow stochastics than I did RSI. So 2 things to take from this: don't or several things really to take from it. Don't overanalyze your charts by stacking on too many indicators. Really, a moving average or 2 and 1 indicator on your chart really is about all you should have on there. You want to define your trend first. That's step number 1, and then determine your entry in the direction of that trend is step number 2, using an indicator below your chart. And remember, never ever counter trend trade, and that's taking trades that are opposed to the trend. In other words, you're trying to call a bottom and a run up. Don't do that. Try to catch a high that runs down, since this is in a downtrend. Stick with the trend. The trend is your friend, and so we don't want to fight that. We want to go with that. Picture it like a stream, a river. You want to go with the flow of that river, not against it. Picture a downtrend being lots more sell orders coming into the market than buy orders. Picture it as the momentum, the order flow heading downward, so therefore you want to join that downward momentum and let it take you along. Just like as if I got in a river and I put one of those little tubes on that looks like a little O shape, and I just hopped in it. Naturally, the flow of that river would take me downstream, and so there's energy already heading in that direction, and I want to have every benefit that I can going for me. Now, is it humanly possible to swim upstream? Maybe I can fight it. Maybe I won't wear out, but sticking with the stream, with the order flow, is the way you want to do that. It's with the momentum, with the trend, with the order flow. So never counter trend trade. Always trade with the trend. And you can find that by putting a 200 SMA or a 50 SMA if you're looking for something in a little bit shorter term on your chart. Take signals only in the direction of that SMA. Don't put too many signals on there, indicators on there. Use probably 1 below your chart at most. Keep your price action large, because you'll see that when I take the RSI off of my chart and remove it, everything becomes bigger. The price action became bigger. The trend became clearer. Candle patterns became more clear. Even the size of the slow stochastic here became bigger, and the signals became more clear and more obvious. So keep those charts big. Look back a good number of days. 4-hour, 40-day charts, hourly, 30-day charts, daily, 1-year charts, etc. Look far enough back in time. Determine your trend. Determine your entry in the direction of the trend. Don't overanalyze it by having too many indicators, especially ones that do the same job, and this will improve your trading greatly. So the moral of this story is to trade with the trend, get that high probability edge. Don't overanalyze, over-scrutinize. Keep your price action big, and this will end up putting more money in your pocket. This is the type of stuff I do every day in our Currency Cross Trader service when I look for live trades for us to take out in the market. And I determine an exact buy signal, an exact stop area, an exact limit area. And I do this based off of some of these simple concepts that I'm teaching you now. If you want to join us in the Currency Cross Trader, be sure to check us out at worldcurrencywatch.com, and you can actually sign up for the Currency Cross Trader there, and you can mimic the trades that I'm taking in the market. We take swing trades that happen over days to weeks, so you don't have to be a screen jockey. This is not intraday trading. But we also take part in some of the big moves that happen in the market that allows us to have some really nice gains. Hope you've enjoyed this. Thanks so much for watching. Bye-bye.